actually time to check your favorite stocks. We were talking about energy stocks there, Rhonda was.
Sure.
And that's, you've got one of your favorites. Well, we'll go through the list first, but one of them is an energy.
That's correct.
Energy play. Last time around, you liked Radio 1, Conoco, EMC. And you have had, well, you had a pretty good run on, on Radio 1, up about some 36% there. This one you're switching to Disney. I think we'll get back to that. We'll see how you did with the others. Conoco, here's the energy play, up about 6.4%, and EMC, the third, the storage play here, down actually, but way up from the depths of where it was at the very end of December. And anyway, so overall, you did very well in terms of there you see it, 11.4% return, beating the Dow, beating the Nasdaq, beating the S&P, beating everybody who all of those are red lines or orange arrows, as the case may be, and so you're looking pretty good on that. Going forward, you're switching Radio 1 to Disney, and then you're sticking with Conoco and with EMC.
Right.
Let's start off in terms of Disney. Now, what do you like about them, and timing especially? Why now?
Right. Well, I don't think Disney's participating in advance in media, and I'm looking at the performance of AOL Time Warner, and Disney arguably has an equivalent collection of assets. They have internet properties. Their theme parks are operating at a very high level, much higher than they have in years. And from just a growth rate standpoint, I think Disney is being held back by concern at the ABC network that Millionaire led their earnings last year, and it's not as popular this year. But I think with that collection of assets, ABC, ESPN, it's a very good play in media, and I want some money exposed to media. The move from Radio 1 to Disney was totally based on valuation. I think we'd gotten our move in Radio 1. We think that Radio 1 still will go higher, but the risk-reward has changed, and I'm watching the advance in AOL Time Warner, which I own, and I'm watching Disney lag, and I think that the market's going to go back and realize that Disney's earnings are still there. They're lower, 3.7% than they had been, but you're still expected to grow at 20% over the next 12 months, and it's a very good collection of assets to add.
And that generally goes very much with your investing philosophy in terms of that identification of the gap and then capitalizing on it. Conoco, you know, we talked about the oils. Interesting that today Exxon, for example, blows away the street in terms of expectations, and they're trading down.
Isn't that incredible?
What's going on there?
Well, there's always, to me, there's always a disconnect to some extent between how companies perform and sometimes how the street values those companies. I think that in this case, you're moving into February, and even though OPEC is beginning to talk about a reduction in the supply of oil, so we don't expect oil really to decline that much precipitously from a barrel standpoint price, the street has all the Exxon Mobil, all the Texaco that it wants to own, and so people are probably going to take profits in this particular security. So that, to some extent, is a lesson, and you can't totally look at fundamentals and look at earnings to ascertain which securities you're going to own.
So what do you like about Conoco?
Right, because it's actually a cheaper integrated oil than Exxon. That's why we went into it in the first place. They have some drilling operations, they have some refining operations, and yet they trade in a 10 to 15 times earnings range, where Exxon is a little bit higher. And so that, again, plays in how we go about, you know, our craft. We're looking within the sectors, if we like a sector, to find those companies that are mispriced compared to their peers and compared to their historical performance.
Okay, I buy that argument on Disney. I buy it on Conoco. EMC, as a value guy. Now, this is very interesting. This is a company with a PE, trailing PE of about 122.
Right, that's right. We've owned EMC since it had a cost of $6 a share. That's what we bought into the company. And one of the first times we actually bought it out as a stock pick that we thought would move up along with the market was the last time we were on your program. And the reason was this. I mean, it started off, it had a little bit of a peak going into that period. But we knew technology was going to sell off. We didn't want companies that were going to be tax loss selling candidates. And we actually moved out of VeriSign in EMC primarily to get exposure to that internet space. EMC certainly is a leader in data storage. The street loves the company. We know the price to earnings is 122, but EMC still, at its size, came out yesterday and said that they expect revenue growth still in the 35 to 50% range. So when you start discounting forward, you can get out to a reasonable approximation of where EMC is going. I believe that it will go back up to its 104, price that it reached last year. And just that's our proxy on technology, that we think that the downside's limited, even though you look at the PE, it's a very expensive stock on that basis alone.
Interesting. We're looking at some other storage stocks on the screen here. Is there anything else in this neighborhood that you could make a similar case for, or is EMC just sort of where you're putting your chips?
It's one and only to us. So Network Appliance has done very well, making inroads against EMC. I think last year EMC began to go down into the mid-range storage. They had been the granddaddy in large enterprise storage, and so they're beginning to even broaden their product offerings. Where they really excel is their sales force. The chairman of EMC has that as a sales-driven culture. They primarily do all of their sales from in-house, and they're very well rewarded and very well incentivized. And so you see them going out and continuing to put EMC units on corporate desktops.
Interesting. Pardon the pun, but profit is a great motivation.
Absolutely.
And we're going to be back with more with Eugene Profit and some more of your phone calls, some more of your emails when Talking Stocks continues here on CNNFn. We are back with an email. Joanne in the Netherlands wants to know about Cisco. Is it going to go back to its old highs? Bought the stock at 60. Should I buy something else? Patience question.
Yeah. Joanne, I own Cisco, and I still would be buying more here. I think that eventually it will get back up to 60. Whenever you have a company like Cisco that leads its market space, that has a very large collection of assets, that's been very well managed, they tend to work through these changes in technology, and I think to some extent the focus has been on the Junipers and networking. But I believe that Cisco still has the products. In fact, I think they came out, they have a new application today in wireless broadband, which is quite interesting. I think we were talking a little bit earlier about the digital subscriber lines, and you see everyone walking around with the Palm Pilots and sort of the futuristic look at we're all going to be connected to the internet. Well, that wireless application is probably going to make the difference at some point in the future. Not today. All the bugs are going to be worked out. But seeing that Cisco's there right now, they're beginning to move into that arena, makes me feel very comfortable. And then I can tell you this, that if you had sold out of Cisco at the end of last year, you asked me this question and you took it as a tax loss sale, then you would have missed the move up that we've had in Cisco, over the last 3 weeks. So I would stick with it. I am.
And the valuation question in terms of Cisco?
Well, it's cheaper than it was last year. And
so are a lot of things.
And absolutely. But you see what happens is Cisco, or that type of company, we're talking about EMC, they're always more expensive. You look at their earnings and you see some of the old, back in the 70s, if IBM kept growing at its rate, it would have been a certain percentage of GDP. Right. And Cisco, you start seeing those same arguments. I think it's slowed down in growth. It's not going to grow at over 50%, but it's still going to grow in the 30% range. And I think that if you discount forward, you're okay on Cisco, and I think you actually have a margin of safety built in here because it's sold off already.
Right. So room to move up. We are going back to the phones, and Darren in Louisiana is next. Go ahead, Darren.
Good afternoon. I had a question on Read-Rite Corporation, where you might see that going in the short term. Well, I'm going to go ahead and hang up and let you go ahead.
Okay. I don't own Read-Rite, but I do own Western Digital, one of its competitors, and the expectation is that the disk drive makers will have good earnings this time through. They've been very poor performers, really, over the last 12 months, and I think that you see the stories about EMC and the demand for storage. Companies like Read-Rite that are actually making the actual hard drives. I wouldn't be surprised if one of these companies go and begin to take out these commodity suppliers to those large network-type storage companies, if you will. So if you own it, I would continue to hold it and be patient with it. We are still patient with our Western Digital, and they have begun to move up in the last week or two.
You know, you mentioned the idea about leadership, market leadership in technology. Here's an unfair question.
Sure.
Identify for us and our viewers and potential investors market leaders of tomorrow when we that next leg up. Or more generally, what do you look for in terms of characteristics?
Well, the hard part about that now, Bill, is that in order to look for those market leaders, you're looking towards innovation. And because we're in a slowing period, it's hard to own innovation because innovation is expensive and it's unknown. And I think that that's a very risky proposition. I think wireless is probably the wave of the future. So when you're looking at wireless type companies, you can either play it with the pure play wireless firms like a Sprint PCS, or you could look at a company like a Cisco that just brought out a wireless application that their earnings may come in from other areas over the next 3-5 years, but they also have that wireless application development so that they'd be, they're in that arena. I think if you're looking in at technology, we know that the internet over the next 3 to 5 years is going to be very important. It has always been important, but we got ahead of ourselves last year. We got to the point where we wanted it all now, and if you see all of those companies like Ariba, which was mentioned earlier, their earnings this year are higher than they were 12 months ago, even though the stocks are lower. And that's what you want to see. You want to see the company's earnings expanding. That's where it'll show.
We got a list of wireless stocks up here. Anything out of here that's a particular favorite for you?
I own Sprint PCS. I think that it's a very pure wireless play. It sold off very aggressively. It got down into the low 20s over the last month, so you could have had quite an increase if you had gotten in it in the low 20s, which we did, luckily. And I think that you probably see a double here over 3 years. Remember, WorldCom wanted to buy Sprint for PCS. Well, WorldCom went away, but that doesn't take away the value of a PCS. At the last Spectrum auction, the large wireless players went and bought up the spectrum, even though the intention of federal government was that you had some small firms come in and participate in that arena. So I think I would put my money on PCS.
Interesting point. All right, well, we're going to be coming back. Lucent lost $1 billion last quarter, but that doesn't seem to be bothering Wall Street, at least not today. Our stocks editor, Jennifer Westhoven, will be looking at Lucent's quarterly numbers when Talking Stocks continues. We've turned negative on both